Hi folks, so today is 31st of January and we have the editorial page of the Economic Times newspaper. So there are multiple articles on the budget which will be coming tomorrow. Uh, let's try to go by one of the articles which is here. Okay, this contains much of the data. Um, let's go with this one. Okay, money is not a commodity. So while leaving ordinary citizens in the hands of pure profit making can be a tragedy in the making. So tomorrow is a budget date. So let's talk money. On the face of it, India's teeming millions seem to fall prey onto a host of modern demands, often with devastating consequences. Okay, some decry greed, others decry materialism, as if these were forms of amartia, the fatal flaw that inevitably leads to character's downfall in Greek tragedies. Okay, a third group lays the onus of blame on society, as if that anarchy and fickle beast, lurking into the future like a drunken bear, had a malicious will of its own. Last month, a 16-year-old boy and his father were found hanging from a tree in Nanded, Maharashtra. An investigation revealed that the son requested his father to buy a smartphone to support his education, but despite his best efforts, the financial the father's financial condition constrained him. So frustrated by what he evidently believed would result in unfair and exclusion and disadvantage, the teenager took his own life. The distraught father followed suit soon thereafter. And there, with a deprecatory sigh, the press has left them to their fate as the pressing demands of sensational news, the budget being one of them, turns elsewhere. Still, this cautionary tale may begin to be reported more frequently in the future. The wants and endings may differ, but the underlying frustration with financial exclusion will remain the same because the need for constant business growth, driven by an insatiable profit motive, will eventually be at loggerheads with the reality of limited resources and basic mathematical accounting. Underpinning all this is the illusion of money or capital, the creation and corporate concentration of which are seen as necessary drivers of economic progress. Just as earning wages is considered a foolproof way to ensure financial security, this is a convenient fiction. Money is neither a precious commodity that automatically fuels equitable growth, nor does it necessarily reflect a fair value of the labor one expends to fuel corporate expansion. In reality, it is a pool of credit tokens issued and guaranteed by the government, which allows one the right to access and consume goods and services. So, but this is not a fundamental right. Rather, it is a privilege controlled by a select group of concessionaries, shareholders, investors, corporations, financial institutions, and others that charge their employees more to consume their goods and services that they pay them to produce the same. This is an ancient modus operandi which was even encouraged by Chanakya to retrieve monies paid to Mauryan era mercenaries by charging them a premium for food and provisions. Then, as now, for the sake of profit and self-aggrandizement, wage earners therefore are expenses that must be optimized, reduced, or even eliminated if a discounted cash flow model demands it. Ironically, the rationale is even more ruthlessly applied as governments, firms, and entrepreneurs look to digitalize and democratize everything to make something more wallet-friendly like a mobile phone. Much of the cost reduction is driven by diluting the quality and quantity of raw materials and features, coupled with considerable process automation. Add to this substantial capex to drive mass production and economics of scale, and a significantly more affordable phone can emerge, becoming the new minimum standard for survival. Obviously, any such success comes with job cuts and wage stagnation, ensuring that no additional burden beyond what is necessary to drive growth and maximize shareholder value is passed on to the consumer. This excludes significant numbers, including the modestly self-employed, from enjoying this fruit of relentless program. Unless, of course, those who are excluded can borrow against future earnings to procure the same. If such a loan is too onerous or impossible to obtain, misery and disappointment can easily follow. So this is the inherent issue with the monetary system founded on the premise that as some grow richer, others will become poorer. So without constant growth in money supply, consumption, and profits, however, the capitalist system becomes suboptimal. The Bolsheviks, for instance, by acknowledging this monetary system and trying to control it, become inefficient capitalists. Consequently, the Soviet Union lingered on for 7 decades, behaving like an increasingly conveniently money grabber that kept the people on subsistence rations. As India rushes headlong to embrace and champion a future in a corralled by the three horsemen of digitalization, automation, AI, and robotics, it should seriously ponder how it will balance the needs of ordinary citizens with the existing challenges of slowing economic growth, a depreciating currency, elevated food inflation, low job creation, and a ballooning subsidy bill. Otherwise, as economic disparity widens, despite a rising average income level, a measure as asymmetric as the distribution of money, the price of modern Indian tragedy may become even cheaper than a budget phone. If this is it, let's go with this one. Consolidating taxes, it's a big deal. India stands on the brink of a major transformation in the sphere of direct taxation. Nirmala Sitharaman is set to introduce a new IT Act with a focus on simplification and modernization, both essential for aligning India's tax framework with its goal to become a $5 trillion economy. While past reforms such as reduction in corporate tax rates have aimed at bolstering the business environment, the need for further streamlining and adaptability remains. In this context, tax consolidation is a potential game changer. It could ease the compliance burden and drive corporate growth. Finance Act 2019 reduced corporate tax rates, giving company an option to avail of tax at a lower rate of 22%. If these companies did not claim exemptions or incentives to boost Make in India, manufacturing companies set up after 2019 could pay tax at 15%, provided manufacturing began on or before March 31st, later extended by a year. So no exemption or incentive could be claimed by such companies if they wished to avail concessional rates. If these options were not exercised, the highest corporate tax stood at 34.94%. Rates have remained unchanged since. So as of January 12, net direct tax collections were 16.9 lakh crore, a 16% increase from the previous year, while corporate tax collections rose from 9.71 to 8.33. Non-corporate tax, which primarily include personal IT, showed a significant rise in collections of nearly 22%. There is a buzz that tax slabs and rates may be tweaked for individuals to give relief to the middle class. This would be the right step. Corporate tax rates are unlikely to be tinkered with, but there is a need for impetus to corporate growth, including ease and tax compliance. So this can be achieved by bringing in tax consolidation provisions. In India, group companies are not treated as a single entity for tax purposes. This provision prevails in the US, Britain, Australia, Canada, Japan, and several European countries such as France, Germany, the Netherlands, and Italy, though rules and criteria vary. The key benefits include offsetting profit and losses. Losses from one company in the group can offset profits from another, potentially reducing the overall tax liability of the group. Simplified reporting. Instead of filing separate tax returns for each entity, the group files single consolidated tax return, simplifying the process and reducing administrative costs. Intercompany transactions. Transfers of assets or services within the group are generally tax-free, which can lead to more efficient management of resources and capital. So in the US, for instance, an affiliated group consists of a US parent corporation and all other US entities in which the parent holds, directly or indirectly, at least 80% of the voting power. A single consolidated tax return can be filed, which enables offsetting losses within the group and simplifies intercompany transactions. So in the Netherlands, tax consolidation is permitted if the parent owns at least 95% of the shares of its subsidiary. In certain instances, foreign subsidiaries can also be included. This enables offsetting losses within group companies. In India, it is common for a parent company to have more than one subsidiary. each operating in a separate line of business. Thus, each company individually meets their tax compliance obligations, be it filing of corporate tax returns, payment of advance or corporate tax, and meeting withholding tax obligations, to name a few. Further assessments are company specific, and scrutiny of transactions such as intra-group transactions results in each company bearing administrative cost for the same issue. While carry forward and set off losses are allowed for 8 years, and unabsorbed depreciation can be carried forward indefinitely, tax consolidation would permit offsetting losses of, say, a newly set up entity against the profit of its parent company. So, this would provide an impetus to setting up new businesses and aid job creation. That is it today.